When you look at your retirement account statement, what do you usually check first? If you are like most people preparing for retirement or already enjoying it, your eyes immediately go to the big bold number at the top, your total account balance. Next, you might glance at how your investments performed over the last quarter. But there is a silent, almost invisible line item that most people skim right past, and it could be quietly taking thousands of dollars out of your pocket every single year. We are talking about retirement account fees. Many retirees carry a subtle, persistent fear that they might outlive their money. You work 30 or 40 years to build a nest egg, expecting it to carry you comfortably through your golden years, only to wonder if an unexpected market dip or medical expense will cut things short. What few people realize is that hidden management and account fees can erode a retirement nest egg just as fast as a market downturn, except fee losses never recover when the market goes back up. So, how much are these fees really costing you, and where are they hiding? Retirement account fees generally fall into three main categories: investment management fees, administrative fees, and advisory fees. The first and most common type is the investment fee, often called an expense ratio. Whether you hold mutual funds, exchange-traded funds, ETFs, or target date funds in your 401k or IRA, the company managing those funds charges a percentage of your total invested balance each year to operate the fund. An expense ratio of 1% might sound tiny. After all, it leaves 99% for you. But math plays a funny trick over time. If you have a $500,000 portfolio, a 1% fee means you are paying $5,000 every single year just in fund management. Over a decade or two in retirement, that compounds into tens or even hundreds of thousands of dollars in lost wealth, money that could have stayed in your account earning interest for your future. The second type is the administrative fee. These are charges for record-keeping, accounting, customer service lines, and legal compliance for plan providers like employer 401(k)s. Sometimes employers cover these costs, but often they are quietly deducted from your balance as a flat annual rate or a small percentage. The third type is the financial advisor or management fee. If you hire a professional or a wealth management firm to manage your IRA or rollover account, they typically charge an annual assets under management fee, commonly referred to as AUM. The standard industry rate is often around 1%. When you add an administrative fee, a fund expense ratio, and an advisory fee together, it is not uncommon for a retiree to be paying 2% or more in total annual fees without ever seeing a single bill in the mail. Why is this so dangerous during retirement? Because of a concept called sequence of returns risk combined with fee drag. When you are accumulating wealth during your working years, your account keeps growing despite fees because you are constantly adding new contributions. But in retirement, the math reverses. You are no longer adding money, you are taking withdrawals to live on. If you are withdrawing 4% a year for living expenses and paying 2% in hidden fees, your portfolio actually needs to generate a 6% return every year just to break even. In years where the market drops or stays flat, paying high fees forces you to sell assets at a loss, permanently shrinking the principal you rely on for income. Fortunately, taking control of your retirement fees does not require a finance degree. You can make immediate, high-impact changes to protect your hard-earned savings starting today. First, locate your fee disclosures. If you have a 401k or 403b, ask your plan provider for your annual fee disclosure notice, often called a 404A5 disclosure. It lists every expense ratio and administrative charge tied to your account. If you have an IRA or brokerage account, look closely at your prospectus documents or account statements for fund expense ratios and advisory fees. Second, evaluate broad market index funds and ETFs. Many actively managed mutual funds carry expense ratios between 0.5% and 1.25%, yet historically, the vast majority fail to beat the broader market over long periods. By contrast, passive index funds that track major market benchmarks often carry expense ratios as low as 0.03% to 0.10%. Swapping high-cost active funds for low-cost index funds can instantly save you thousands of dollars a year without changing your core asset allocation. Third, review your advisor arrangement. If you work with a financial advisor, ask them to explain their fee structure clearly. Are they charging a percentage of your portfolio, a flat hourly fee, or a fixed retainer? If you have a relatively straightforward portfolio and only need periodic guidance, switching from an ongoing percentage-based advisor to a fee-only, hourly fiduciary advisor can keep significantly more money in your account. Finally, if you have left a former employer and still have an old 401k sitting there, compare its administrative fees against a rollover IRA. Old 401k plans often carry unnecessary record-keeping charges that you can eliminate by consolidating into a low-cost, self-directed IRA at a major discount brokerage. Your retirement savings should be working for you, not quietly funding unnecessary Wall Street expenses. Taking one afternoon to audit your accounts, read the fine print, and lower your fees gives your nest egg the protection it deserves, ensuring your money lasts as long as your retirement dreams do.